Every market crash looks sudden until you realize the warning signs were always there, hiding in plain sight. The truth is that financial disasters don't erupt out of nowhere. They are built slowly, brick by brick, through patterns so consistent and so eerily repetitive that once you learn them, you can't unsee them. That is the uncomfortable reality. Markets crash for the same reasons today as they did centuries ago, long before Wall Street, long before central banks, long before the modern global economy even existed. But the real fear isn't the crash itself. It's the morning you wake up and discover that everything you thought was safe, your investments, your savings, your home's value has dropped faster than you can react. Millions of people have lived through that moment. Millions more will. The question isn't if we'll see another crash. It is whether you'll recognize what is coming before the rest of the crowd does. What if the signs were already flashing in front of us? What if history wasn't just a long list of old stories, but a coded warning that every generation keeps ignoring? And what if the same psychological traps that drove tulip traders in 1634, stock speculators in 1929, and mortgage lenders in 2008 are quietly repeating themselves today? Today, we're going to break open the four patterns that always appear before a market crash, the signals that have preceded every major financial collapse in recorded history. These patterns aren't theories. They're observable laws of human behavior wrapped in economic clothing. They show up in manias, in bubbles, in panics, and in every single crash that reshaped the world from tulip mania to Black Monday to the Great Recession. Before we dive in, I want you to check in with the community. Tell me in the comments, where are you watching from? And if you want more long-form, high-depth breakdowns of financial history, the way it actually happened, not the cleaned-up version, hit subscribe. This channel is building a global community of people who want truth, not headlines. Because by the end of this video, you're going to understand crashes in a way most investors never will. To understand the first pattern, we need to go back farther than most financial textbooks ever dare to go. The year is 1634, and the Netherlands is in its golden age. This tiny nation, freshly independent from Spain, has just built the world's first stock exchange. Their ships dominate global trade. Wealth floods into Amsterdam like never before. In a way, the Netherlands is the Silicon Valley of the 17th century. New money, new ideas, and a new class of investors who believe they've discovered a system that can only go up. But beneath this confidence lies the oldest psychological trap in finance, the belief that this time is different. And that belief becomes the kindling for the world's first documented market crash, tulip mania. Tulips were rare, exotic, and beautiful. A single bulb could cost a full month's wage. People didn't just want them. They displayed them the way people flex luxury watches today. It was status. It was identity. It was proof that you were part of the rising world. Then speculation took over. Tulip prices rose, and then they rose faster. Wealthy merchants started buying not because they wanted flowers, but because they expected someone else to pay more tomorrow. And the moment that expectation takes hold, a bubble is born. Then came the innovation that changed everything. The Dutch invented a primitive futures market contracts to buy tulips at a locked-in future price. Soon, these contracts were being flipped the way day traders flip meme stocks today. Nobody cared about tulips anymore. They cared about the paper representing them. At the peak, a single bulb could cost the equivalent of 5 years of salary, the kind of money you'd spend on a house, not a flower. This wasn't economics. This was mass hypnosis. Every bubble in history has this moment, the phase when logic dies, risk becomes invisible, and greed becomes a social contagion. Investor overconfidence is not just a contributing factor to market crashes, it is the ignition source. And when tulip prices finally stopped rising, the illusion shattered. Futures contracts collapsed, fortunes evaporated, farmers, merchants, and investors were ruined. The world had just witnessed its first modern market crash, but the pattern behind it was timeless. Because whether it's tulips, dot-com stocks, crypto coins, NFTs, housing, or AI startups, every bubble begins with the same psychological fuel: overconfidence, euphoria, and the belief that the rules of financial gravity no longer apply. Tulip mania may feel primitive, distant, almost too simple to compare to the complexities of modern finance. But the deeper truth is that nothing about it was unique. The specifics change, but the psychology never does. At the heart of every bubble lies the exact same human impulses that drove Dutch traders nearly 4 centuries ago. Overconfidence is indeed just a pattern, it is the recurring flaw in human nature that turns ordinary markets into explosive manias. Every generation believes it is more sophisticated than the one before it. Every era thinks it has better tools, better data, better technology, better safeguards. The Dutch believed that futures contracts were cutting-edge financial innovation, Investors in the 1920s believed the telegraph and the ticker tape eliminated risk. Traders in the 1980s believed computer-driven portfolio insurance could outsmart volatility. The early 2000s believed liquidity and endless real estate appreciation made mortgages risk-free. Today, people believe AI, algorithms, and real-time analytics have made markets more efficient. But the more advanced a system becomes, the more confidence people place in it. And the more confident they are, the more reckless the behavior becomes. That is the hidden mechanism of financial bubbles. Not technology, not new assets, not economic growth, but human psychology amplifying risk until the system becomes fragile. What makes bubbles so dangerous is that participants don't see themselves as irrational. They see themselves as smart. They see rising prices not as a warning, but as validation. The longer a boom lasts, the more investors assume it must be safe, the higher prices go. The more people convince themselves it's justified. Every bubble contains this silent shift. People stop asking what something is worth and start asking what someone else will pay. Value disappears and narrative takes over. When tulip traders said, "You can always grow more bulbs later," it was the exact same logic that drove home buyers in the mid-2000s to say, "Housing never goes down." Or crypto traders in the 2020s who said, "We're early. This is just the beginning." When a market transitions from analysis to storytelling, the bubble has already begun. This transition is almost invisible when you're living through it. That's why even intelligent, informed people fall victim to the same cycles. Humans are wired to follow crowds because for most of human history, following the group was survival. But in financial markets, following the crowd often means buying the most overpriced assets at the worst possible time. Tulip mania wasn't about flowers. The dot-com bubble wasn't about websites. The housing crash wasn't about mortgages. They were all about the same thing, the human desire to believe that the future will reward our optimism. And bubbles always end the same way, not because someone finds a fatal flaw, but because confidence breaks. When people stop believing prices will rise, they stop buying. When they stop buying, prices fall. And when prices fall, the illusion of safety collapses. Suddenly everyone wants out, and no one wants in. That moment when buyers disappear is the moment every bubble dies. Now that we understand the psychological foundation, we can move to the next pattern. One that takes this natural human bias and feeds it with rocket fuel, regulatory failures, and institutional blind spots. Because while optimism and speculation create bubbles, it is the lack of oversight toward the wrong kind of oversight that turns bubbles into catastrophes. To see this pattern clearly, we need to leave the tulip fields of the 1600s and step into the roaring optimism of the early 20th century, where the United States stood on the brink of unprecedented wealth, unaware that its greatest economic triumph was about to be followed by one of the darkest collapses in modern history. By the time the 1920s arrived, America had transformed from an agricultural nation into an economic powerhouse. Factories were roaring, wages were rising. New technologies like radio and automobiles were reshaping daily life, and the stock market became the national obsession. The newspapers described it as a new era of endless prosperity. Investors believed industry had become too advanced, too modern, and too efficient to ever collapse again. But beneath this glittering optimism was a regulatory vacuum so large that it allowed a fragile, debt-fueled financial bomb to grow unchecked. The seeds of the 1929 crash were planted decades earlier in 1907, when a sudden bank panic nearly toppled the entire American financial system. That crash was contained only because one man, the financier J.P. Morgan, used his own fortune to stop the bleeding. It was a warning, a signal that the system was dangerously unstable. But the lessons were misread. Washington responded by creating the Federal Reserve in 1913. But its role was poorly defined, its tools were misunderstood, and its relationship to financial markets was ambiguous. Instead of building a strong regulatory structure, America built a halfway solution, one that gave the illusion of oversight without actually providing stability. Then came the 1920s. America emerged from World War I as a creditor nation for the first time, flooded with gold, liquidity, and industrial might, with the world depending on U.S. loans and production. American policymakers became convinced that prosperity was self-sustaining. They believed the economy could police itself through the wisdom of markets. It was the era of laissez-faire capitalism, government staying out of the way, allowing businesses to operate without restriction. The Federal Reserve, still inexperienced, was reluctant to interfere with market behavior. Regulators intentionally looked the other way because no politician wanted to be the one who interrupted the parade of prosperity. This vacuum created the perfect breeding ground for financial innovation without oversight. Leveraged investment trust began proliferating across Wall Street, These trusts acted like mutual funds but supercharged by leverage. They borrowed heavily to invest more than they actually owned. Regular Americans, seduced by rising stock prices, poured their money into these trusts, unaware that they were buying into a fragile pyramid built on borrowed cash. The trusts became wildly overpriced, often trading at double the value of the actual stocks they held. It was the tulip story repeating itself, now dressed in the sleek machinery of modern finance. Margin trading became the real accelerant. Investors could buy stocks using borrowed money, sometimes putting down only 10% and borrowing the remaining 90%. This meant that if a stock rose by $1, the investor made huge returns, but if it fell by $1, they were wiped out instantly. By 1929, brokers loaned a staggering amount of money to everyday Americans, creating a mountain of margin debt with no safety net. The Federal Reserve saw the danger, but hesitated. Political leaders begged them not to interfere. The markets looked strong. Optimism was everywhere, and no one wanted to believe that the boom was artificial. The pattern of regulatory failure was now complete. Warning signs were ignored. Risks were underestimated. Oversight was absent, and a generation of investors was lulled into false security. Then, in October 1929, reality returned with brutal force. Stock prices dipped slightly, prompting a few margin calls. Those margin calls forced investors to sell. The selling triggered more margin calls. The cycle accelerated until the market was in freefall. Within days, billions of dollars of paper wealth vanished. Investment trusts imploded. Brokers failed. Margin traders lost everything. And the government, so confident that the market could regulate itself, found itself helpless to stop the avalanche. The Great Depression that followed was not the product of random misfortune. It was engineered by neglect, fueled by unchecked speculation, and triggered by a system that had no guardrails. 1 in 4 Americans lost their jobs. Thousands of banks failed. The rules that were supposed to prevent instability simply didn't exist. The regulatory blindness of the 1920s didn't just contribute to the crash, it amplified it, turning what could have been a correction into a global catastrophe. But if the 1929 collapse was a warning about the dangers of underregulation, the next major crash revealed the opposite danger, the illusion that innovation itself is stability. Because sometimes the threat isn't that regulators fail to act, it is that the market outgrows the very tools designed to protect it. To understand this, we need to jump ahead to a different era, when fast-growing financial technologies created an illusion of safety, so convincing that even the experts were fooled. And when that illusion dissolved, the result was the worst single-day market crash in history. The late 1970s and 1980s were a renaissance for Wall Street, an age of ambition, excess, and soaring confidence in the power of financial engineering. Computers were becoming more advanced. Trading floors were digitizing. Algorithms were entering the scene. And a new breed of financial mathematicians armed with models, formulas, and complex equations promised a future where risk could be eliminated through innovation. It was the era when finance became scientific, when investors believed that markets could be tamed, optimized, and insulated from collapse through the sheer brilliance of new technology. But this confidence was built on a dangerous illusion. The same tools designed to protect investors would ultimately magnify instability, exposing the terrifying reality that the market does not break because humans make mistakes, it breaks because humans underestimate the systems they build. The innovation at the center of the 1980s boom was something called portfolio insurance. It sounded harmless, even helpful, like a financial seatbelt. It was based on the theories of Fisher Black and Myron Scholes, whose groundbreaking work laid the foundation for modern options pricing. The idea behind portfolio insurance was simple on paper. If the market started to fall, computers would automatically sell futures contracts to offset the losses, limiting the downside. It was a kind of self-correcting mechanism, an algorithmic failsafe that promised to stabilize investor portfolios during downturns. The promise was so seductive that institutional investors rushed in. Pension funds, hedge funds, and major banks dumped billions into these automated strategies, believing they had finally solved the age-old problem of market risk. By 1987, more than $80 billion worth of investments were riding on portfolio insurance. Yet the entire system rested on a single, catastrophic assumption that markets were liquid enough to absorb automated selling during a downturn. This was a fantasy. While portfolio insurance was gaining momentum behind the scenes, Wall Street was also swept up in another frenzy of leveraged buyouts. Corporate raiders were snapping up companies, flipping them for profit, and driving stock prices upward at a breathtaking pace. Ordinary investors, seeing the wealth being created overnight, poured their savings into markets, convinced that the boom would never end. Financial writers declared that downturns were a relic of the past. Universities taught that markets were efficient and rational, This optimism fed a bubble, and the bubble fed complacency. Behind the scenes, regulators were falling into the same trap. They saw the market rising, unemployment falling, and GDP growing, and assumed stability was permanent. Just like the 1920s, no one wanted to interfere with success. The Federal Reserve worried about inflation, but remained hands-off. The SEC, unfamiliar with algorithmic trading, could not grasp the systemic risk building underneath the surface. Once again, a lack of oversight ensured that when the system failed, it would fail spectacularly. The cracks began to show in the fall of 1987. Rising interest rates and a weak dollar rattled investor confidence. The market dipped slightly, nothing dramatic. But to the algorithms running portfolio insurance programs, that dip triggered automatic sell signals. Each sell order nudged prices lower. Those lower prices triggered more sell signals, and more, and more. Then came October 19, 1987. What began as a gentle decline turned into a vertical collapse. With each tick downward, computers dumped more stock index futures onto the market. Liquidity vanished. Prices fell faster than humans could react. Sell orders flooded exchanges. Markets spiraled downward uncontrollably. Not because investors panicked, but because machines obeyed their programming. Dow Jones Industrial Average fell 20.6% in a single day, the worst one-day drop in American history. To put that in perspective, this was more severe than the worst day of the 1929 crash. Entire portfolios evaporated in minutes. Traders stood helpless as prices plunged and no buyers stepped forward. The algorithms that were supposed to prevent losses had instead accelerated them, turning a normal correction into a historic freefall. For the first time, the world saw the dark side of financial innovation. It wasn't malice. It wasn't greed. It was complexity, systems too intricate for humans to fully understand, operating at speeds too fast for regulators to control. And in those systems, a small disturbance could become a runaway catastrophe. Black Monday shattered the belief that financial engineering could eliminate risk. It revealed that technology magnifies human errors rather than erasing them. It showed that innovation, when misunderstood, becomes its own form of systemic risk. And most importantly, it proved that markets are not rational machines, they are ecosystems, sensitive to pressure, easily overwhelmed, and deeply interconnected. Yet as damaging as the 1987 crash was, it was also a warning of something more dangerous, a pattern that would reappear with devastating force decades later. Because innovation alone doesn't cause a crash. Overconfidence alone doesn't cause a crash. Regulatory failure alone doesn't cause a crash. What truly brings a system to its knees is when all of these patterns collide with something even more explosive: debt. Debt is always the quietest part of a financial expansion. It builds slowly, invisibly, tucked inside balance sheets, mortgage contracts, credit lines, student loans, corporate bonds, and exotic financial products few people ever read. It feels harmless at first, just numbers on paper, just signatures on a dotted line. But in every major crisis in modern history, debt is the invisible accelerant, the silent fuse that burns beneath the economy until the moment a spark ignites, and the entire system explodes. Debt alone does not cause market crashes, but debt always magnifies them. A system built on borrowed money becomes fragile. A shock that would be manageable in one era becomes catastrophic in another. And the 2008 financial crisis remains the clearest, most devastating example of what happens when all for historical patterns: overconfidence, regulatory blind spots, misunderstood innovation, and excessive debt collide at the same time. The early 2000s looked like a dream. After the dot-com crash, investors fled risky tech stocks and turned to something they considered safe, stable, and eternal: housing. Homeownership had always been a symbol of the American dream. Now, Wall Street found a way to turn that dream into the most profitable machine in global finance. That machine was built on securitized debt. Banks began bundling thousands of mortgages together into financial products called mortgage-backed securities. Then they repackaged those into even more complex instruments known as collateralized debt obligations. These structures created the illusion of safety by mixing good loans with bad loans and hiding the risk behind layers of mathematical models. Credit agencies stamped them with AA ratings, not because they were safe, but because the system rewarded optimism and punished caution. Behind the scenes, however, something far more dangerous was happening. Lending standards collapsed entirely. The entire goal of the banking system shifted from serving homeowners to feeding the securitization machine. Borrowers were approved for mortgages they could not possibly afford. Risky loans were handed out to anyone who asked. No income verification, no down payment, no documentation. They were called liar loans, ninja loans, and subprime mortgages. But ultimately, it did not matter. Wall Street was not evaluating borrowers. It was harvesting signatures. debt began to pile up everywhere. By 2007, total U.S. household debt exceeded $14 trillion, far higher than the country had ever seen before. Mortgage debt grew by more than 160% in just a few years. Homes doubled in price. Investors bought second, third, fourth homes not to live in, but to flip. It was tulip mania with drywall. It was portfolio insurance with granite countertops. It was the Dutch bubble, the 1929 optimism, and the 1987 innovation all over again, but this time on a national scale, injected directly into the bloodstream of the global economy. The regulatory environment only made things worse. The government pushed aggressively for higher homeownership rates. The Federal Reserve kept interest rates unusually low for years, making borrowing cheap and irresistible. Banks lobbied for deregulation, and regulators happily obliged. And just like in 1929, the watchdogs trusted the markets to police themselves. They believed financial innovation had made the system safer. They believed models could predict the future. They believed the housing market was unbreakable. Then came the spark. Mortgage delinquencies in the subprime sector rose past 79% in some regions, an unimaginable number for an asset class considered safe as houses. Suddenly, the mathematical models failed. Banks realized the securities they had marked as safe were loaded with toxic debt. Investors fled, confidence evaporated, and the entire system unraveled with terrifying speed. On September 15, 2008, Lehman Brothers, founded before the Civil War, a titan of American finance, collapsed under the weight of its own leveraged bets. The stock market plunged, credit markets froze, banks stopped trusting each other, entire neighborhoods fell into foreclosure, homes abandoned like casualties of an economic war. What looked stable had been held together by debt, and once that glue dissolved, the collapse became unavoidable. The financial crisis spread worldwide because the U.S. had exported its toxic securities across the globe. European banks bought them, pension funds bought them, governments bought them. Countries that had nothing to do with American housing policy suddenly found themselves dragged into recession. The meltdown was not just a banking crisis, it was the reckoning of a global financial system built on the belief that debt could grow forever without consequence. The pattern was undeniable. Every crash we've studied, from tulip mania to the Great Depression to Black Monday to the housing collapse, shared the same underlying chain reaction. Investors became convinced the boom would never end. Regulators took a hands-off approach. A new innovation promised safety while hiding risk. And debt amplified everything until the smallest disturbance became a catastrophe. 2008 was not the result of a single bad decision. It was the predictable outcome of a system that repeats its mistakes because it refuses to confront the one truth markets never want to hear. Unsustainable debt always collapses. The only question is when. And this brings us to the present, where the patterns of history are resurfacing with uncanny precision. Tech valuations have soared. Corporate debt is higher than at any time in history. Household debt has once again broken records. New innovations, cryptocurrencies, AI-driven trading, leveraged debts promise safety while hiding new forms of risk. And as investors rush into every rising trend, convinced they can flip assets for a profit, we are watching the same psychological cycle that played out in 1634, 1929, 1987, and 2008. History does not repeat itself, but it echoes. And today, those echoes are growing louder. If there is one lesson that echoes through every chapter of financial history, it is this: markets love illusions. They rise on faith, confidence, and the belief that tomorrow will always be better than today. Crashes happen when those illusions break. And the reason crashes feel sudden is not because the signs are invisible, but because no one wants to look at them while the party is still going. Yet the patterns we explored are not ancient relics. They are living forces repeating now in real time. In the modern economy you participate in every day. The most dangerous moment in any market cycle is when people convince themselves that this time is different. It is the same phrase tulip investors muttered in 1634, certain that rich merchants would always pay more for rare bulbs. It is the same logic investors used in 1929, believing leveraged investment trust would deliver endless growth. It was the comforting lie portfolio insurance whispered to Wall Street in 1987. And it was the delusion homeowners clung to in 2006 when they insisted housing prices could never fall because they were not making any more land. The language changes, but the psychology never does. Today, overconfidence hides behind new names. People insist artificial intelligence will reinvent productivity and eliminate risk. Others believe digital assets will replace traditional finance altogether. Investors trust computer models, just as they did in 1987, assuming algorithms can outsmart human emotion. But markets are not machines. They are collective psychology, and no algorithm has ever fully modeled fear. The regulatory landscape has also begun to mirror the past. Governments struggle to keep pace with innovations such as decentralized finance, AI-driven trading, and private credit markets quietly expanding beyond oversight. Some regulators hesitate to intervene because rapid innovation boosts economic growth. Others do not understand the technology well enough to predict its dangers. The result is a familiar vacuum, the same one we saw before 1929, when oversight lagged behind financial creativity, and the same delays that enabled the buildup of toxic mortgage securities before 2008. And once again, new innovations are being celebrated long before they are understood. Cryptocurrencies, stablecoins, leveraged trading products, AI ETFs, and decentralized financial instruments all promise superior returns, efficiency, and freedom from traditional systems. But beneath the marketing lies the same vulnerability seen in every historical crash: human behavior amplified through technology. In the tulip era, traders flipped paper contracts instead of flowers. In 1987, computers executed trades faster than humans could think. In 2008, banks bundled mortgages into securities no one truly examined. Today, innovations are becoming more complex, more abstract, and more detached from real-world value. And that detachment is always where fragility begins. The final pattern, the most consistent of all, is debt. Household debt in many countries has surpassed previous records. Student loans have crushed entire generations. Corporate debt has ballooned to the highest levels in modern history, as companies borrow cheaply to buy back their own stock. Governments across the world have accumulated unprecedented debt loads, fueled by emergency spending and low interest rates that lulled leaders into believing money was infinite. When interest rates rise, all of this leverage becomes unstable. Debt is tolerable when money is cheap. It becomes suffocating when money tightens. And history shows that rising interest rates have preceded nearly every major financial downturn. So how do you see a crash before it happens? You look at the patterns, not the predictions. Predictions fail, patterns don't. The first question is whether investors are buying based on fundamental value or based on the belief that someone else will pay more tomorrow. When you observe markets rising too fast, too far, detached from earnings, realistic growth, or tangible utility, you are seeing tulip mania in modern form. The second question is whether regulators are missing something obvious, either because they fear slowing growth or because they do not understand the new system well enough to intervene. When innovation outpaces oversight, cracks form beneath the surface. The third question is whether new financial products are being adopted faster than they are being understood. Whenever investors use tools they cannot explain, history begins to rhyme. And the fourth question is whether debt is quietly expanding beneath the economy, inflating prices, increasing risk, and making the system more fragile. If you examine today's markets through these lenses, you will see warning signs everywhere. None of them mean a crash is inevitable, but all of them mean a crash is possible. And when history stacks as many signals at once, the wise investor prepares, not panics. The truth is that no one can time the exact moment the market will fall. Not in 1929, not in 1987, not in 2008, not today. But you do not need to time the crash to survive it. You only need to understand how the cycle works. A crash is not the end of the market. It is the reset. It is the transfer of assets from the impatient to the patient, from the overconfident to the disciplined, from the leveraged to the prepared. And the investors who thrive are the ones who recognize the opportunity hidden inside the fear. The worst mistake an investor can make is selling everything in panic when the downturn begins. Markets fall, but they also recover. Historically, the rebounds have not just restored value. They have created enormous wealth for those who continued to invest while prices were low. Cash feels safe during a crash, but cash erodes under inflation. Gold feels secure, but gold rarely outperforms the stock market when dividends are included. Timing the drop feels clever, but nearly every study shows long-term investing outperforms jumping in and out of markets. The best strategy is simple, but difficult. Prepare ahead of time, stay disciplined, reduce unnecessary debt, keep a reserve of cash to buy when assets are cheap, and continue investing consistently whether the market is rising or falling. Crashes create generational opportunities, but only for those who still have capital when everyone else is running for the exits. If history teaches anything, it is that markets will crash again, not because of fate or fear, but because cycles are built into human behavior. And when the next downturn comes, you will recognize the signs long before the headlines appear. You will understand the psychology, the forces, the patterns, and the mistakes. And instead of watching the crash in fear, you will watch it with clarity. That is the difference between being caught in the collapse and rising through it.